Hello, everybody. Welcome to the third quarter of 2018 market review for Verdence Capital Advisors. My name is Leo Kelly. Today is October 11th, and we're actually at a very interesting stage in the year. Today, on October 11th, as we film late in the day, the market is down 500 points after an 800-point move down the prior day. So we have a lot of activity in the market. Today's review, we're going to look back at the third quarter. We're going to talk about what's happening now in the market, and we're going to give some insight on where we think the market is headed, the economy, and some different areas where we find value. So it's an interesting market so far this year. It's really a tale of two markets. It's been a tale of two markets all year, where we look at the growth market and technology stocks have really driven the market. So on our first page, we'll see market returns for this year have been quite high in a very, very narrow band. As a matter of fact, for a good part of this year, we saw just 10 stocks in the S&P 500 driving all of the return of the entire index. That actually broadened out a little bit in August, and then we started to see some volatility. Now, if you go back to our second quarter performance review, we talked about the fact that the market was extraordinarily narrow. We also mentioned in that specific review that this whole process, when the market gets this narrow, tends to get to its peak spread between the haves and have-nots sometime around August. That's usually followed by volatility in September and October, which we mentioned in the last review. This breaks up the market, it brings back some sanity, and usually the undervalued stocks start to come back and provide some leadership. So here we are, again, just as it was in 15, just as it was in 11, just as it was in 7, just as it was in 1999, we have this tight spread year. We had it peak out, that gap peaked in August. We started to see these high-flying tech stocks start to move backwards in September, and here we are in October. As we tend to be frequently, October is normally a very volatile month. We're volatile again, and as we look at returns, I'm going to show you some returns here this year, but they've already changed dramatically in just 11 days. So through the third quarter, we saw the S&P 500 and large cap stocks do very well. International stocks have not done well. We're going to talk about the U.S. economy, but these trade wars that are coming about because of tariffs, we get that question quite a bit. How is that going to affect the market and the economy? We can see here it is affecting the market. The U.S. has been making new highs. China is in a full bear market. So there is an impact. The question is, how does it impact an economy and a market, and who is impacted? In this particular case, two very different stories, whether you're sitting in China or in the United States. Now, what's happened in the 11 days in October is tech stocks have come down dramatically. Growth stocks are down more than twice the amount of value stocks. So as we discussed in the last quarterly review, that spread between the haves and have-nots in the market up through September is starting to contract actually very rapidly in all of this volatility. It's been a tech-led rally, as we can see here in the sectors in the gray. All information technology led, and as we talked about, is already starting to turn back somewhat. In terms of fixed income, as we've been saying for some time, we expected interest rates to start to rise. That's actually starting to happen at a little bit faster pace. We think that's actually what's worrying the market right now. And so as interest rate rises, bond prices go down. So this is important. We have been very defensive this year, and as a result, you'll see if you're in high yield or floating rates, you've done better. If you're in lower duration or shorter term bonds, you've done better than traditional long-term bonds, which have not fared well. Fixed income as an aggregate, using the Barclays aggregate bond index, is actually down this year. So this is one of those times which we've warned about where will bonds actually hedge stocks when they go down? Well, so far in October, that's not the case. Bonds and stocks are both going down. In terms of commodities, oil price are going up. We're seeing some shortages. We're seeing demand increase, supply decrease. We have issues with Iran right now. We have issues around the world, and supply is being threatened. This is important for one specific reason. We talk about it all the time. Commodities go up and down, none more than oil. Oil swings back and forth. But what we know for certain is whenever oil's down at a low, everybody says it will never go up again. And whenever it's at a high, everybody says it's never going down again. Well, I want to remind everybody, it was just 2 years ago where everybody said, we will never see oil prices recover above 50, and here we are again, oil's back up $70, $80. So whenever we hear the word never, take caution, and usually that's exactly the point where things start to change. As we dig into the third quarter review and go on into the fourth quarter, we're starting to think about this in the Ds, okay? We call them the 5 Ds. Divergences. Divergences in markets create opportunities. Dislocations in value. We're seeing that at a level that we have not seen in quite some time. Actually, we're seeing as many dislocations as we have seen since 1999. Discipline, as we always say, and the last couple days are starting to prove it. You have to have discipline in your long-term asset strategy. Now, discipline comes in 2 forms. Discipline comes in keeping a diversified portfolio, maintaining a risk profile, so that when you have choppy markets like this, you don't take the big hit on the downside. But what discipline also is when markets pull back, it's having the discipline to bring up your risk in your asset allocation and reinvest back into that downturn so that you can take advantage of the recovery when it eventually occurs. So again, discipline is important in volatile markets, and we're starting to see those volatile markets again. Dare to go against the crowd. That's where you find value. So anybody who loaded up in August at the peak of the gap and said, I can't take it anymore. Tech is going to win forever. And valuations don't matter. And it doesn't matter if something's cheap. You have to own these names. You have to own the FANGs. Well, they're not having a good 6 weeks. And so we always say, dare to go against the crowd. Go find value. And diversify. So we talked about that with discipline, diversification. That lowers risk. That gives you opportunity. And at a time like this where we're seeing very volatile markets, we're going to start to see the value of that diversification. We're 10 years into a bull market. In the last couple of years, we've seen very low volatility and a straight up market. And these FANG stocks just keep making new highs and new highs. The S&P 500 drives higher and higher. And people ask the question, why don't I just put it in an index fund? Well, we're about to see why as we start to see some volatility in the market.